Hey, what's up, 10 baggers? Welcome back to the channel dedicated to finding investments that can help us 10x our portfolios. Today, I'm not going to be talking about specific companies per se. I'm actually going to be discussing what it means for a company to have a moat and how we can determine whether there is a moat worth investing in when we're evaluating companies. If you find the content useful, please drop a like as it helps the video get more views, which means we can grow our community. Also, I'm going to leave a free PDF in the description below, which will have questions that may help you determine whether a company has a great moat or not. If that's something you're interested in, please get your hands on it. It's just going to be a free Google Drive document. Okay, so let's jump into the video. Okay, so again, today we're going to be talking about moats and how they relate to investing in the stock market. The term was made popular by Warren Buffett, and at its simplest, a moat is a very durable competitive advantage. Many companies have some competitive advantage, but not all companies can reside in a castle protected by a wide and deep moat. As a growth investor, we're usually trying to identify moats that haven't been quite identified by analysts yet, and that is where you can beat the market to great investments. Potential 10 baggers. I remember being amazed at two things about Amazon when I was in high school. The speed and ease of the delivery and the ease of making a return. I remember thinking, like 10th grade, what a great customer service experience they had. This was literally 10 years ago, and it was certainly an opportunity for me to identify an extremely strong moat that was forming around Amazon's business. Now, at the time, I was only in high school. I had literally no money to invest, and my family didn't either, and just didn't cross my mind. But in retrospect, I can think about these things and realize that Amazon was going to be a fantastic investment for the next decade. Now, not all businesses with seemingly future moats can turn out like Amazon. But when you take a shot at investing in a growth stock you have encountered, in the words of Peter Lynch, the most you can lose is your investment, and the best you can make is infinity. Okay, so now that you know what the basics of a moat is, let's talk about different types of moats. It's obviously the best when a company has multiple types of moats in one business model, but we're going to go through each type of moat individually so we can figure out exactly what they are and then relate them to real-world businesses. Okay, so in my opinion, the easiest type of moat to understand is being a cost winner. One example of a cost winner rose to prominence is Walmart. Back in the day, Walmart was able to infiltrate neighborhoods across the United States and compete with local stores on price. Because Walmart had seamless supply chains, there really was no competition for shoppers. This aggressiveness to expand and take market share from local stores is what led Walmart to be a 700 bagger since 1980. This means that $10K invested in the stock in 1980 would be $7 million today. And that's not even counting dividend reinvestment, which I'm sure would make it 1,100 or 1,200 bagger. So pretty crazy investment there, all from a simple moat, which is cost advantage. The next type of moat kind of goes hand in hand with cost advantage, but that is from a company operating at the largest scale. So when I think of scale, what this reminds me of is one of my favorite investments, Visa. So Visa processes most of the digital transactions in the world, and together with MasterCard, they control over 80% of the market share of transactions across America. It is highly unlikely that another company will be able to compete both with Visa and their services while gaining market share from them in such a way that Visa would not be successful anymore. Because they dominate market share and already have worked out the kinks to their fantastic business model, which includes multiple income streams, as the rest of the world moves more and more towards digital payment processing, both through increasing penetration in mature markets like America and just by virtue of developing nations getting debit cards, credit cards, and mobile payments and stuff like that, I imagine that Visa will only continue to dominate for the next 10 to 15 years. That is a strong moat, in my opinion. So the next type of moat can come from high switching costs. Now, this is one that I don't like quite as much, but it makes a lot of sense. So once a customer, large or small, signs up for a service, it may be difficult for them to switch from that service if there's a high switching cost. This reminds me of companies like Verizon and AT&T, and utility companies like Con Ed. I mean, what is New York City going to do? Completely change where they get their electricity supply and service from overnight? That would be an insanely ridiculous undertaking, very expensive for the city. So regardless of Con Ed's financials as an investment, New York is always going to use them. So you can be confident in the safety of your investment. It might not be, a multi-bagger investment, but Con Ed is going to be around because of the high switching costs. One stock that I invest in, which I believe benefits from high switching costs, is ServiceNow. They're a leader in cloud-based IT operations for enterprises and have recently benefited from the work-from-home movement, and they're very good at retaining and adding customers. They have deep penetration into the largest enterprises in the United States, and the likelihood that another type of cloud-based IT service can make up for the cost of switching with any kind of worthwhile value proposition would be highly unlikely, in my opinion. It would mean that this competitor that takes over from ServiceNow must be miles ahead of ServiceNow in the type of services they offer, which no company is, in fact, because ServiceNow is literally the leader in this industry. So it would just be highly impractical for a company to switch away from using ServiceNow as their cloud-based IT servicer. The next type of moat can come from intangible assets. Now, intangible assets are kind of weird. They can come in the form of assets that a company has which no other company has access to, which could be a patent for a drug or a technology that is unique to an individual company. But I believe that the most valuable type of intangible asset is a brand. An extremely strong brand can take a company miles. One thing that pops into my mind, one company that pops into my mind is Nike. Their products aren't really much different from that of an Adidas or another sportswear company. Like, you can play basketball in Under Armour basketball shoes just as easily as you can play it in Nike basketball shoes. And, regardless of whether it's comfortable or not, the reason why the majority of consumers go with Nike is because of their strong brand. And that's why they can pay a premium on their products, because their brand is so strong. I don't think there's really anyone that doesn't recall the Nike commercial, "Just Do It." You can go up to almost anybody in America, you could say "Just Do It," and they'll know you're talking about Nike. That is brand awareness, that is brand strength. That's an intangible asset that Nike has that you just can't start a sneaker company or a clothing company that creates a better product than Nike and just replace that brand. People aren't going to buy your product just because it's better when Nike has the absolute strong brand awareness across the nation. So that is an example of an intangible asset that a company could have, such as Nike. So finally, my favorite type of moat, I think this is the type of moat that is going to lead us into the future. It's created from something called network effects. So network effects are extremely valuable because they make the product more effective as more users join or use the product, thus encouraging even more users to join. This is a positive feedback loop. An example of this is Facebook. As it becomes even better product, as more people join, you get to see more of your friends and family, so thus more people join, and then it's like weird if you're not on Facebook. That's a network effect. And the business itself benefits from this network effect. So it's just a positive feedback loop. So the more people join, the more people you get to connect with on Facebook, and the more money Facebook can make. It's a win-win for both companies. I'm not getting into all the privacy stuff right now, but that's just the basics of how Facebook got such a strong moat on the social media market. Another example of a network effect comes from a stock that I really want to invest in, and I've been kind of falling into that trap of always saying it's overvalued, I'm going to wait, is a stock called CrowdStrike. So CrowdStrike uses artificial intelligence to fend off cybersecurity threats for large enterprises. And the way that it works is, the way that the bare bones of their technology is that as the AI encounters more threats, CrowdStrike programming, the AI program, learns about the threat, thus making it better, and again more able to deal with a similar threat. So it's then a more attractive software to other large enterprises, through which it will counter more threats, thus constantly learning how to combat the threats that large enterprises are facing in terms of cybersecurity. And then it'll get to a point where it knows so much about potential threats that come towards the AI software knows so much about potential threats that could come towards large enterprises, that it'll be almost impossible to say that you have a full cybersecurity stack without licensing the CrowdStrike software. And that is the power of a network effect. It's a incredible positive feedback cycle that basically forces the company into everybody's business model, because it just becomes so good as more people join it, as more customers buy it. So that is the different types of moats as I see it. Now, ideally, you're looking for companies who, have some of these, or maybe all of these factors. I think it's unlikely that a company would have all of these factors, but a combination of some of these moat factors, as well as being sort of an early company that maybe these moats aren't being valued properly by analysts. I think that's where we can really hop on a company that has the potential to really grow and appreciate in share price as the moat actually comes to fruition in the future, or as it rides a trend, or even if it's powerful moat right now, analysts are just not aware of it, thus keeping the share price kind of stagnant, or maybe not as valued to what the market should value it at. So constantly be on the lookout for stocks that have different moats, different combination of moats. So I have in the description a Google Drive PDF or a Google Drive document that is just a little questionnaire that I created that can help you, when you're looking at investments, determine how strong a moat is of a company. So if you feel like you can give really robust answers to the 3 questions on that document, then the company probably has a pretty strong moat, and it's likely a good investment. Now, there's different aspects to what make a good investment, at least in my eyes, and I'm going to do videos on that as well. But identifying the moat of a company is a really great place to start. Okay, so that's my video, guys. Please let me know what you thought about my video, and share with the community if there are any stocks out there which you believe have a developing moat. Feel free to download the PDF in the description, which has questions which may help you learn about moats. And as always, have a great day and happy bagging, folks.